Hello traders, today is the 8th of October 2012 and the time in London is 15:56 p.m. in New York 10:56 a.m. This is the CCI Reloaded part 1. In this series of video we will discuss various aspects of this indicator and show traders how one can use efficiently the commodity channel index indicator. At the end of this series of video, one will be able to filter out CCI signal. This video is for educational purposes only. It's neither a solicitation or an offer to buy or sell any financial instrument. It is primarily for a TSTW S008 Let's get started. On this chart, we can see the commodity channel index. Okay, period 21. The setting is for 21. Okay, right here, the commodity channel index, period 21. And also on the chart here, okay, we can see the blue line is the exponential moving average 21. The green one is the simple moving average 21. Okay, so the blue line, remember, is the exponential. The green one is the simple moving average 21, both 21. Okay, what we are trying to do is to explain to traders, okay, what the CCI indicator is about, okay, how one can use it accurately to make excellent trading decision when we are talking about practical trading. Okay, let's get started. So here we have our CCI we are on the weekly chart, and we are looking at the pound-dollar currency pair on the weekly chart. Very important. All right. So I want you to pay attention to the CCI. The CCI is comparing, okay, the price to a moving average. So right here, I'm using the CCI 21, which is telling me that, in fact, the CCI 21 is comparing the price to the exponential, okay, moving average 21. Some trader may say is the simple moving average 21. Okay, so that's why I put here, okay, the blue line, which is the exponential moving average 21, which is faster than the simple moving average 21, which is the green one. But a lot of traders will prefer the simple moving average 21 because it's slower than the exponential moving average 21. But there are various reasons traders use a simple or exponential. That's why I put both here, okay, to show traders what the CCI 21 is doing. So the CCI 21 is comparing the price, I would just say, to a moving average 21. So you can use a simple moving average or exponential, okay, 21. Okay, all right. So right here we can see that if the CCIs, okay, you see the black line here, this is the zero line. The zero line, okay, represents, okay, the simple moving average 21 or the exponential 21 because we are using CCI 21. Okay, so the zero line represents the moving average to which the price is compared to. Okay, so if you are using CCI 14, the zero line will represent, okay, the moving average 14. If you are using, for instance, the CCI period 30, okay, the zero line will represent, okay, the moving average 30. All right. Now, okay, so I don't want to go deeply into it in this first part. In the second part, we'll talk about another aspect of the CCI indicator. Okay, so here we can see that the zero line represents, okay, the simple moving average 21. I will talk about simple moving average 21. But remember that, okay, the blue line represents the exponential, okay, 21. But I will be talking about simple moving average 21 because it's lower, okay? All right. So whenever we see that the CCI, you can see here, the CCI 21 was near the zero line here, it's telling me that the price is also near the simple moving average 21. You see, pay attention to my vertical line. You see here, the CCI is near the zero line. At the same time, the price is near the green line, which is the simple moving average 21. Okay, that's why it's telling me sometimes there are some okay, discrepancies, so to speak, okay, which mean there will be a disagreement between what the CCI is telling us or a divergence. Okay, this is the correct word, the divergence between the CCI and the price. Okay, but here there is a convergence, which means the CCI indicator is near the zero line. At the same time, the price is near the simple moving average 21. Remember that if you were using, okay, the CCI period 14, when the CCI is near the zero line, in normal condition, repeat, in normal condition, the price also should be near, okay, the moving average 14 if you are using 14. In this case, we are using 21. But remember, there is sometimes divergence or due to volatility or distortions, okay, you may see sometimes that, okay, they will be speaking different languages, so to speak, all right? All right? So when the price moves away from the simple moving average 21, the CCI 21 will be away from the, okay, the center line, you see? The center line represent, in this case, because we are using 21, the center line represent the moving average 21, which is right here. You can see that the CCI moves away from the center line. At the same time, we see the peak point here, okay, right here, where my cursor is. The price was also away from the simple moving average 21, which is the green line here. The price deviate, move far away from the simple moving average 21, okay? Here you can see that after the price went away from the simple moving average 21, it returned back to the simple moving average 21 right here. At the same time, okay, you can see that in fact the CCI, okay, went below, okay, it did below because the price went below, you see, right here, the price went below, okay, the simple moving average 21. In fact, when we are using, okay, the simple moving average, we are using the CCI 21, we are comparing the price to the simple moving average 21, okay? So you can remove the CCI and just place the simple moving average 21 if you want to use the CCI's 21. If you want to use, for instance, CCI 14, you can place instead, okay, simple moving average 14 and just look at the price in relation to your, okay, the moving average 14. If you are happy with the CCI 8 or CCI 10, CCI 12, whichever setting that you are using for a specific time frame, okay, you want to understand what is the role of the CCI is comparing the price to a moving average. In this case, one can use a exponential or a simple moving average. And as you can see on the weekly chart, because the higher the time frame, okay, we prefer the simple moving average. But if you're on a lower time frame, you may see that maybe the exponential moving average will do a better job, okay, for day trading purposes. Okay, all right, so you see now, okay, but because we're on the weekly chart, we want it to slow down to smooth it nicely. So the simple moving average on the weekly chart is doing a good job. All right, so you can see here the price, okay, it did below the simple moving average 20. You can see the CCI also went below the center line a bit, okay, only to turn around here. It's just telling us, okay, what the price doing. The CCI is duplicating the movement of the price. In fact, the price is the number one indicator. All the CCI is doing is moving the movement of the price, moving the movement of the price, which means the CCI is discarding the volatility aspect of the price and smoothing, rounding the price movement for us to tell us, okay, the average direction of the price itself, the number one indicator. As I explained to traders before, when one is looking at the indicator, one is likely to make a wrong decision. The price, the number one indicator, traders should keep eyes on the price, okay? The second thing we want to remember in this video is that indicators will give warnings, but the price must confirm the signal by giving to us a direct signal. All right? Okay, so you see now, so here we can see that the CCI right here, okay, all right, is rising, okay. At the same time, the price also is rising. If the price was going down, the CCI also will be going down. Sometimes you will see a divergence due to volatility or distortion, okay. You may see a divergence, but very often the CCI, okay, is positively correlated to the price itself, the number one indicator. So if, for instance, I change my CCI to 10, I will place on my chart, okay, simple moving average 10. But remember that if you go to the higher time frame, it's better to use a simple moving average. But if you're on a lower time frame, like hourly, 4 hours chart, 2 hour chart, it's better to compare it to a moving average. Because for day trading, we don't have the whole day. I would prefer to use exponential moving average for day trading purposes, okay, to compare the price to that exponential moving average, okay? All right, so this is one aspect of the CCI. In the second part of the video, we will discuss another aspect of the CCI, the overbought condition of the CCI indicator and the oversold condition of the CCI indicator. Okay, before we close this video, I want to highlight one point that we will discuss in the third part of this video. Okay, the slope of the indicator. Okay, so the CCI is comparing the price to a moving average. We want to focus also on the direction, on the slope of the moving average. Is it sloping up? Is it sloping down? Is the deviation taking place, okay, when the moving average is sloping up? Or is the deviation taking place when the moving average is horizontal? Is the deviation taking place when the moving average is rising? Okay? All right, so just remember, okay, the role of the CCI is to compare the price, okay, to a moving average. We can perfectly get rid of this CCI right here. We do not say that the CCI is useless. It's an excellent trading tool to help traders that are learning to trade, okay? But it's a mathematical formula that is replicating, okay, the activity of the price itself, the number one indicator. That's why I say to traders, keep eyes on the price itself, the number one indicator. I'm just going to bring quickly Apple stock, okay? All right. Moment, please, ladies and gentlemen. I'm expecting, okay, some delivery very soon, okay? Some nice, okay, pizza now. So you may see very soon somebody, okay, or a bell may be ringing or somebody knocking, okay, on my door, okay? Now, this is on the, okay? Now, ladies and gentlemen, moment, please. We're on a weekly chart for Apple stock. What can we see here? We can see that, okay, this is the CCI 21 again. The blue line, as I explained to you, is the exponential 21, exponential moving of 21. The green one is the simple. You can see there's no big difference in this case for Apple stock. As I put these two indicators together here, no big difference between the green and the blue, as you can see. And the CCI is replicating the movement of the price. As the price moves away from the moving average 21, you can see the CCI also. The center line is somewhere here, somewhere in this zone where I put the horizontal line, not exactly, but in that somewhere in that zone. That's the center line, which represents the moving average itself. So as the price move away from the moving average, the CCI also is moving away. Okay, you see here, it move away from the simple moving average. Okay, away. You see it's near the center line. Okay, it move away. See, yes, it move away, but we can perfectly see here. You see, it was going away from it. Here you can see that it's a divergence. Very often this diversion, we will see it in the third area wave. For those who are mastering the area wave theory, the CCI will reach its highest point, which means above 200, above 300, but then it will start changing direction because the CCI cannot go further up. But because the bullish momentum is very strong in the third area wave, you may see a kind of diversion taking place in the third area wave, and traders will be busy selling during this time. Those who are trading indicator, and they will make a lot of wrong decisions. Those who keep eyes on the price, drawing the trend line, will make excellent trading decisions. I invite you to follow me in the next part of this video when we will discuss the overbought and oversold condition for the CCI indicator. Thank you for watching, and we will speak to you very soon. We are the TSTW S08 traders. Speak to you soon.